The United States is bankrupting Canada. It explains why debt-to-GDP ratio is the worst in the G7. Canada has become a branch-plant economy. In this video, I will reveal the real mechanism driving this decline and why it is harder to escape than you think.
Chapter 1. The Dissonance. If you look at a standard political map of North America, you see two distinct entities. Two sovereign nations separated by the 49th parallel. Two governments, two central banks, and two currencies. But maps are often misleading because they show jurisdiction, not function. If we switch to a map of economic velocity, energy flows, capital movement, and supply chains, that border effectively dissolves. In functional terms, North America is not two economies. It is a single integrated industrial machine worth $30 trillion. For the smaller partner in this union, this integration comes with a hidden cost. We are told that Canada maintains monetary sovereignty, the power to set its own interest rates and control its own financial destiny. This is a comforting political fiction. In reality, the Bank of Canada operates within a gravity well generated by the U.S. Federal Reserve. When the Fed moves, Ottawa must follow. And as we will see, the mechanisms that bind them are not political choices. They are mathematical inevitabilities of the global bond market. Chapter 2. The Historical Trap. To understand why this trap exists, we have to look at how the Canadian economy was engineered. For most of the 20th century, the relationship was symbiotic. Canada possessed what the United States needed: raw materials, timber, minerals, and eventually oil. The U.S. provided the capital to extract it and the market to buy it. This was the branch plant economy. It created a massive dependency. Today, 77% of Canada's total exports go to just one country, the United States. This is a level of concentration that is rare in the developed world. It essentially makes the Canadian GDP a derivative of American demand. But in the early 2000s, this dependency became toxic due to a phenomenon known as the Dutch disease. As oil prices rose, foreign capital flooded into Canada to buy that oil. This drove up the value of the Canadian dollar to record highs, at one point trading above the US dollar. While this was good for oil companies, it was catastrophic for manufacturing. A strong dollar made Canadian factories too expensive to operate. The result was a hollowing out of the economy. When the oil boom ended, the factories didn't come back. Canada was left with a stripped-down industrial base dependent entirely on selling resources and real estate. Chapter 3. The System. Impossible Trinity. This structural weakness brings us to the core economic mechanism that binds the Bank of Canada, the Mundell-Fleming trilemma, or the Impossible Trinity. The theory states that a country can only choose two of these three options. It is mathematically impossible to have all three. Canada has chosen free capital flow. It needs foreign investment to fund its deficits. And it claims to want independent monetary policy to manage its own economy. But the theory dictates that if you choose these two, you must accept a volatile currency. The exchange rate becomes the shock absorber. In a closed economy, that might be acceptable, but in Canada, where consumer goods, technology, and food are largely imported, a collapsing currency leads directly to imported inflation. This creates a soft peg. The Bank of Canada cannot actually allow the currency to crash because it would trigger an inflation crisis. Therefore, they effectively lose their independence. They must shadow the Federal Reserve to keep the currency stable. The Trinity wins every time. Chapter 4. The Divergence. 2025. For 20 years, this system was stable because the US and Canadian economies were synchronized. But in the post-2020 era, a great divergence has occurred. The United States has entered a regime of fiscal dominance. The government is running massive deficits, trillions of dollars, to reshore manufacturing and build a wartime industrial base. This spending creates growth, but it also creates sticky inflation. This forces the Federal Reserve to keep interest rates higher for longer. Canada is in the opposite position. It is not reindustrializing. It is deleveraging. The Canadian economy is burdened by one of the highest household debt-to-GDP ratios in the G7. Growth is stalling. The economy is desperate for a rate cut. This is the asymmetric trap. Ottawa needs to cut rates to save the housing market. Washington needs to hold rates to fight inflation. They are moving in opposite directions. Chapter 5. The core mechanism. Rate parity. So, what happens if Canada tries to break free? What happens if the Bank of Canada cuts rates to 2.5%, while the US stays at 5.5%? The mechanism of interest rate parity activates immediately. Global capital, pension funds, insurance giants, sovereign wealth funds seeks the highest risk-free return. If the US Treasury pays a 3% premium over Canadian bonds, billions of dollars of capital will sell the loonie and buy the US dollar. It is an algorithmic stampede. This capital flight causes the value of the Canadian dollar to freefall. Economists estimate it could drop below 65 cents US. This triggers the feedback loop. A 65-cent dollar makes all imports 35% more expensive. The price of food, fuel, and electronics spikes. So the central bank's attempt to save the economy with low rates is negated by the destruction of purchasing power. The cure causes a new disease. Chapter 6. Human Impact, Mortgage Channel. But the mechanism isn't just about currency. It transmits directly into the monthly expenses of the average citizen through the bond market. In Canada, the most common mortgage is the 5-year fixed term. This rate is priced off the 5-year government bond yield. Because North American financial markets are integrated, Canadian bond yields are highly correlated with U.S. Treasury yields. When U.S. yields rise, they drag Canadian yields up with them. This means that even if the Bank of Canada cuts its overnight rate, fixed mortgage rates may not fall significantly if the U.S. economy remains strong. We have created a scenario where Canadian homeowners are effectively paying American interest rates on Canadian incomes. The friction is absorbed by the working class and the young, who see their disposable income vanish into debt servicing costs, while the structural problem remains unsolved. Chapter 7. Conclusion. The dissonance we feel, the gap between what we are told the central bank can do and what it actually does, stems from a misunderstanding of sovereignty. Sovereignty is not a flag or a seat at the UN. It is a measure of economic leverage. Canada has spent decades integrating its supply chains, energy grids, and capital markets with a superpower 10 times its size. It has reaped the benefits of access, but it has traded away the benefits of control. In a globalized financial system, the junior partner in a monetary union does not get to steer the ship. It can only brace for the turns. You can have deep economic integration, or you can have independent monetary policy. You cannot have both.